the renewed effort to roll back stifling banking regulations. According to the Wall Street Journal, a new bipartisan effort could spell relief for dozens of banks. Senators have reached an agreement to ease the rules on small and mid-sized lenders, scaling back some of the regulations put in place by Dodd-Frank. The legislation would cut the number of banks subjected to heightened oversight from the Federal Reserve. Joining us right now is the CEO of Silicon Valley Bank, Greg Becker. Greg, good to see you. Thanks so much for joining us.
Good morning.
We want to talk about what's going on in Silicon Valley in terms of the IPOs and the activity. Sure. But first, let's stay on regulation for a second. Have you seen an impact to your bank?
Yeah, I mean, you look at the last 7, 8 years, clearly we've had a lot of additional regulatory burden on us as an institution as we've grown. So it's kind of our growth rate along with the regulations it's been pretty hard for us to deal with. There's a lot of regulations that do make sense, but this last one where we just crossed a 50 billion threshold, so going from 50 billion, that's a really big deal. So really applaud Senator Crapo for working in a bipartisan way to look at moving that 50 billion up to 250 billion. That would be very beneficial to us.
What would that enable you to do? I mean, and tell us why that's beneficial.
Yeah, I mean, there's only so much money you have to spend on different things, right? And invest in the business is one thing. Another way to spend the money is on regulatory oversight, whether it's adding additional people, additional controls, all those things that there's a part that's good, and there's a part that's going too far, I would say, that actually doesn't lower the risk to the institution. And so I'm again, really applaud moving it up.
Do you see, in terms of regulation easing up on making loans with all the paperwork you have to go through now, which has hurt small and mid-sized businesses? You saw Jamie Dimon, head of J.P. Morgan, said the other day that $1.5 trillion to $2 trillion of loans that normally would have been made in this cycle weren't made because of regulation. So the SIFI thing you talked about, raising that 50 billion threshold, good. But in terms of the everyday burdens of making loans, is that being eased so small and new businesses households have easier access to credit?
So at Silicon Valley Bank, we've been fortunate. Our loan growth over the last 5, 6, 7 years, we've been averaging roughly 20% plus per year. So we really haven't slowed down, and that's both in the commercial side as well as in our private banking side. It's really about how do you continue to stimulate that growth on a go-forward basis, both domestically and globally. So I believe keeping the threshold where it is actually would hurt us. Therefore, moving it up, we expect to see benefit and invest more in the business.
Is the compliance, federal compliance, is that burden being reduced? And I was a director at MetLife. That's a state-regulated business. When the feds got involved in it, when they were treating us as a bank, the amount of money we had to spend and staff we had to hire just to comply with federal regulations was really a burden. Is that being reduced for you?
We hope to. We hope to see it. There's a little bit happening right now, but when you look at the growth rate of different expense areas of the institution, Silicon Valley Bank, we've actually had substantial growth. In fact, the biggest area for growth from an expense perspective on a percentage basis has been in the risk area. So clearly, if you can lower that growth rate or actually keep it flat, that benefits us. We can invest in other areas of the business that will stimulate the economy.
Most people don't realize, really, the impact of the regulatory environment that we've seen in the last decade. It's the reason that businesses have been sitting on cash and unwilling to put that money to work in terms of hiring new people or investing in new projects. And this president has been the least regulatory president, reducing federal pages by better than 30%. I think that's one of the reasons that the economy has shown a 3% growth rate. What do you think?
Well, I think that the benefits from that is still yet to come. I think you'll see more of that in 2018. Look, it's November, and we're talking about bank deregulation still. So, and a lot has been done, and I think it will help drive the economy going forward.
And here we are with a month and a half left in 2017. The IPO story wasn't great in 2017. What can you tell us about that?
Yes, so coming into 2017, we predicted that this is going to be the year of liquidity or a lot of IPOs happening, and clearly that hasn't been the case.
Well, look at all these unicorns: Uber, Airbnb, SpaceX, Palantir. They've been quiet, and we'll see if they go public in 2018.
Yeah, well, part of it is they can raise capital at very strong valuations on a private basis, and it's hard being a public institution or a public company. So if you can stay private and you can accomplish two things, which is one is raise capital to fuel the growth, number one, and also provide liquidity to your employees, so they actually are getting some benefit. They can take that money and actually cash in some of their stock. They get two benefits. So if you can do that on a private basis, it makes sense. So the unicorns that are out there, 88, and the largest ones, most of them raised money this year on a private basis. So they don't have to go public the same way they would historically.
Where is all the private money coming from, though? Because it's just investors that are, they see this bull market in its 9th year. They're like, let's look for an alternative investment. We'll put money in a VC that can help these unicorns.
Well, part of it is there's not that many places where you can see this level of growth rate. So these companies, these unicorns, many of them are growing at 50, 60, 70% per year. You don't see that with traditional companies that are public, right? You see slow growth. So if you can invest in those businesses, you hope for a very good return, solid return. So the money's coming from...
The valuations aren't holding up in the public market.
They're starting to. What I would say is the last 5 IPOs that went out, they're all trading above their IPO range, which is my view is a good indicator that things are on a good path.
It's interesting. You asked such an important question, because I think what's happening right now is all of these big tech companies have venture arms. So you've got Amazon with a venture arm, Microsoft with a venture arm. They're investing in the unicorns, aren't they?
So you have corporates that are coming into the unicorns. You also have, and actually not just the unicorns, but companies in general. You have venture capital. It's had another year of really strong capital raising. You've had SoftBank's Vision Fund, right? Which is around $100 billion, which again, those dollars are massive when you look at the whole scheme of things.
But is this going to create an antitrust problem? Handful of big companies, that's where you get the capital to get absorbed by them or controlled by them. We don't have the proliferation of small tech companies that we've had in the past. How do we get that back again?
There is still a lot of companies, tech companies, that are raising capital, right? Not at the pace it was in 2015 and 2016, but you're still looking at thousands of companies that are raising venture capital. So I still think the market's healthy, and you have to look at it both domestically and globally. So we're bullish, not just on the larger tech companies, we're bullish on the medium and even the small companies that are out there. They're able to raise capital.
What's the regulatory barrier to having more IPOs where if you can't get it from a VC, you can go out in the market and get out?
The regulatory burden, I don't think it's as great as just the fact that it's painful to be a public company, right? Under that scrutiny, right? Every quarter you have to release their numbers, and if you're off by a little bit, your stock drops dramatically. Well, if you're private, your stock price doesn't vary. So you can focus on the business more than spending every quarter thinking about how am I off a quarter, am I off a few cents here or there. So
and it's gotten worse.
It makes it easier.
That was the case 10 years ago, but it's gotten worse in the last 10 years in terms of the fees and just the expense around
to be a public company.
Regulations. Yeah, great to see you, Greg. Thanks so much. I wonder if we're going to see a heavier hand in terms of regulation on the tech sector.
That's coming.
Because they're getting more powerful and more powerful. They know everything about us. Even though this president has been such a regulatory-friendly leader, I bet you we see a heavier hand when it comes to tech. I don't know. Greg, good to see you. Thanks very much for joining us. Greg Becker.